Okay, so picture this. It's a super familiar story. You open your trading app, you buy this trending stock, and boom, you watch it jump like 20% in a single afternoon. You're feeling totally invincible, right? Like an absolute financial genius. So the next day, riding that incredible high, you throw in even more of your paycheck. But suddenly, out of nowhere, the market crashes, and literally within hours, months of your hard-earned savings just completely vanish into thin air. You're just sitting there, staring at this red screen in total disbelief.
It's a completely devastating scenario, but honestly, it happens to thousands of people every single day. And it brings up this massive question that we have to answer if we're putting money into the market. Why is it that studies constantly show 90% of short-term retail traders actually lose money and fail over time?
Looking at this data, the reality is pretty harsh. The market is brutally divided. To get into that elusive 10% of winners, you quickly realize it's not really about picking the perfect stock or getting incredibly lucky. It's actually about mastering your own emotions, strictly managing your risk, and following a set of golden rules.
Let's just compare the mindsets here, because the contrast is honestly staggering. Amateurs, they treat the market like a casino. They're just gambling, reacting, and relying purely on hope. But professionals know a vital truth. Trading is a strict, calculated business. They prepare relentlessly, and above all else, they manage risk. So if you want a real shot at long-term survival, you've got to adopt that professional approach.
To build that professional mindset, this explainer is broken down into 5 phases. We've got the 90% trap, planning and capital protection, mastering trading psychology, the path to consistency, and finally, 5 mistakes to avoid.
All right, let's jump straight into phase 1, the 90% trap, moving from illusion to reality.
Which brings us right to phase 2, planning and capital protection. This is all about what happens before you press buy.
And what's wild is that the most crucial decisions you'll make actually happen before you ever place a trade. That's rule number 1, never trade without a plan. You've got to answer 4 specific questions beforehand. Why are you entering? Where exactly do you exit if you're wrong? Where are you taking profits? And how much capital are you actually risking? If you don't know the answers to those, you're literally just relying on hope. And guys, hope is definitely not a strategy.
Okay, rule 2 flips amateur logic totally upside down. Your first goal isn't actually making money. Crazy, right? Your first goal is protecting the money you already have. Think about the brutal math here. If you lose 50% of your capital, you don't just need a 50% gain to recover. You need a 100% gain just to break even. Protecting your downside by risking just a tiny fraction per trade is what keeps you in the game. Because if you lose it all today, you simply can't trade tomorrow.
This leads us directly to rule 3, which relies on a concept called the stop loss. Think of this as your portfolio's emergency brake. Let's say you buy a stock at $100. Instead of watching it drop and just praying it rebounds, you decide right off the bat, hey, if this hits 95, I'm out automatically. It completely removes your ego from the equation, and it stops one bad trade from completely destroying your account.
To wrap up the protection phase, Rule 7 is absolutely critical. Never trade with scared money. We're talking rent, borrowed funds, or your emergency savings. Using that kind of money guarantees you'll feel immense financial pressure. And you know what that pressure leads to? Total panic. And panicked emotional trading is where logic just completely flies out the window.
Let's move on to phase 3, mastering trading psychology. This is really the internal battle.
So rules 4 and 5 are all about trading your actual strategy, not your impulses. Picture this. A stock skyrockets 15% out of nowhere, and everyone online is screaming at you to buy. The FOMO is so real. But if you impulsively chase that jump, you'll probably end up buying right at the absolute peak. Professional traders know that sitting out and missing an unpredictable jump is always better than rushing into a highly dangerous trade. Patience is a massive advantage here.
And that patience lets you lean on Rule 6, which uses the famous saying, "The trend is your friend." Think of the market like a fast-moving river. Sure, you can try swimming upstream to catch a quick reversal, but honestly, you're just going to exhaust yourself. No trend lasts forever, for sure, but aligning yourself with the heavy momentum of the market drastically improves your odds of success.
Moving right along to phase 4, the path to consistency and surviving long-term.
For Rule 8, it's pretty straightforward but absolutely crucial. You have to keep learning. Markets are constantly evolving ecosystems. New tech, changing economies, stuff that worked beautifully 5 years ago might totally drain your account today.
So you have to be perpetually studying charts and staying on top of financial news. Your knowledge needs to compound over time, just like your money.
Rule 9 is keeping a trading journal. Now, I know it sounds a little tedious, but trust me, this is the secret weapon of the pros. Just like professional athletes watch game footage to improve, you need to log exactly why you entered a trade, how you felt, and what actually worked or failed. When you do that, your personal improvement becomes a measurable science instead of just random guesswork.
All of this feeds into Rule 10. Think long-term. So many people want to get rich in a few weeks with one lucky viral stock. But true professionals, they focus on consistency. And yeah, consistency can be kind of boring, but in trading, boring is highly profitable. Stacking small, disciplined gains over a long period is infinitely more realistic than chasing that one spectacular lottery ticket win.
Finally, let's hit phase 5. 5 mistakes to avoid. Essentially, what not to do. Let's do a rapid-fire checklist of the absolute worst pitfalls. First, overtrading out of sheer boredom will bleed your account dry through tiny fees. Second, ignoring those stop losses we talked about earlier. Moving your safety net is just a guaranteed disaster. Third, trading on unverified social media rumors. Fourth, excessive leverage. Borrowing money might magnify your gains, but it will violently magnify your losses. And lastly, revenge trading. If you take a bad hit, do not instantly double down in a blind rage trying to win it back. Just step away from the screen.
Ultimately, the big takeaway from all this is that the market consistently rewards preparation, not predictions. The best traders aren't magically right all the time. They're actually wrong quite a bit. But they are incredibly disciplined. If you can master the boring, daily process of strict risk management and accept small losses without letting your ego get in the way, the actual profits will naturally follow.
So I want to leave you with this final thought from our explainer today. When you wake up and open your trading app tomorrow morning, are you going to rely on blind hope and treat it like a gamble at a casino? Or are you ready to finally prepare like a professional and treat your portfolio like a disciplined business?